You're the owner of a small business, which means you're also the tech guy, and HR, and personal assistant, and head honcho, and intern. You could use another pair of hands, like the experts you'll find at Verizon Small Business Days, April 21st through 27th. Get a free tech check, special deals, and more. Call 1-800-483-4428 or visit verizon.com/smallbusiness to book your appointment. Verizon Business.
Reality radio for a really great future. We're talking real money.
Hi, this is Tom Cock. I'm always concerned when people say it's different this time, this strategy no longer works, and you gotta think differently about the future. Those things always concern me when it comes to your money because generally there's an interest in the statement that they want you to do something that may be in self-interested. Now, this was written recently in Bloomberg. Bloomberg's writers, I generally like the advice. I think it's very reasonable and it tends to be balanced. But in this case, the discussion was whether or not a balanced portfolio, 60% in stocks, 40% in bonds, works anymore. And when I say works, provides some return, reduces the volatility over time, and could be a decent retirement portfolio, right? 60% again in stocks, 40% in bonds, and you're able to take income off it. And the discussion here was it really doesn't work anymore, or it's not going to work anymore, I should say. The reason? Bond yields are so low and equity valuations are so high. Let me repeat that. The interest you're getting from the bonds you're in is very, very low. Interest rates are low, and the Federal Reserve has said they're going to keep it that way. And equity valuations, stock market valuations are so high. In their words from Bloomberg, the strategy's reputation for solid, steady returns is in serious doubt. And what do they suggest? Well, they look at a number of potential things. Putting, instead of the money that you're going to put in bonds, put it in gold. Using alternative investments, which is, wow, last decade, if I had a nickel for every person who said I should put it in alternative investments, I would have been retired on my 60-40 a long time ago. They do, however, admit with the alternative investments that they're very expensive, could be up to 3% a year. How about commercial mortgage-backed securities? How about leveraged loans? How about owning more stocks and less bonds? Couple things to keep in mind here. Okay, first of all, higher yield on the bonds. Gets people in so much trouble. There's an expression in our business, more money's been lost seeking yield than at the end of a gun, right? In other words, more people lost money trying to make money on the safer things like bonds than a holdup, right? So let's talk a little bit about the 60-40 and what you really should consider. First of all, no one knows from this day forward the future of stock or bond returns. Now, we can say we're in a period of low interest rates, but we're also in a period of fairly low inflation, right? And certainly no one can say they know what the future of stock prices are going to be. I will say this because I hear the whispers. Yes, the Standard & Poor's 500, large U.S. companies are at record highs. That said, a lot of other parts of the market are not, that probably you should be looking into owning. U.S. small company value stocks, U.S. small stocks, international stocks, emerging markets, REITs, all kinds of other things you could own in your portfolio that are nowhere near their all-time highs. Number two, using expensive products to try and increase your return. Wow, the investment graveyard is littered with those ideas. Not a good one. And then the other one about owning more stocks, having a higher stock exposure because you're going to need that because bonds aren't going to pay you enough. Now, remember, the reason that you're in the 60-40 is you're kind of a chicken, right? I mean, you want to make the money, but you don't want to see your portfolio go down dramatically in the next bear market. So a higher equity exposure equals greater volatility. So if your retirement is racing at you faster than, well, another bad joke from me, here's what I suggest. Number one, get truly diversified. Most of you come and see us and you say, I am diversified. It turns out you're really the S&P 500 plus bonds. Other parts of the market are important. They have been important, especially when the S&P 500 or large U.S. companies are trading at record highs. Do you remember the late 1990s? Wow, I certainly do. Number two, do not go out and try to make more money with your fixed income, your bonds, because this has led to tragic mistakes. 2008, Vanguard's own high-yield bond fund lost a quarter of its value. Nothing wrong with Vanguard, but the portfolio is full of corporate securities where the corporations could not make the payments, right? Number three, here's what I think is the crux of the matter. Have a robust plan, especially if you're within 5 years of retirement. What am I talking about? When we work with clients and prospects for that matter, we give you a free hour to help you. We run 1,000 scenarios of what the future could look like. This is a huge, huge deal. Don't just do it on the back of an envelope. Don't even do it in a spreadsheet. Get professional help so you have a robust plan that looks at all of the different 1,000 scenarios of how stocks and bonds may act into the future. Don't get caught up in the hype. I still believe in the 60-40. We don't know what the future looks like, but those who have a tendency to move to new strategies thinking they found financial nirvana generally pay a high price. I'm Tom Cock.
Talking real money. We hope you realize that the information provided on Talking Real Money is for educational and hopefully enjoyable purposes only. Providing personalized financial planning or investing advice takes time, so please consult with a really good fee-only fiduciary investment, tax, or legal advisor. We know a good one. Investing must always involve risk. In other words, you can and probably will lose money at times. Also, as much as you want it, no one can accurately, consistently predict the future. So past performance doesn't tell you a darn thing about what the future will bring. Unlike many other programs that say something similar, Talking Real Money is not trying to get you to buy or sell any financial products or securities. Instead, the program is provided as a public service by Vestry, a fee-only registered investment advisor. Thanks for listening, and please visit TalkingRealMoney.com for more information and disclosures. That should keep the lawyers happy.